All right, so in this video, I'm going to talk a little bit about stock price maximization and kind of how it links to valuation a little bit and to kind of get you thinking about a few things. So if I was looking at PE ratios, the PE ratio is the price per share divided by the earnings per share. And if I was looking at that as it related to the value of a share of stock, it'd be interesting to kind of decompose that. So that's kind of what I have done here. So if I'm thinking about P1, that would be the expected future price. So that one subscript means in the future, say one period, however long a period is. Basically, I could think of that as being the result of that future PE ratio times whatever I expected the future earnings to be. Now, if you think about that, we've got all kinds of problems already, right? So a future PE ratio, which we don't know, future earnings, which we don't know, right? So there are some challenges here, and that doesn't even scratch the surface on some of the other problems we've got with this that I'll talk about here in a minute. So, but this does kind of lead us to some interesting thoughts here. So if I wanted to look at the change in the price and what was going to happen with the change in price over time, then I could actually do a little bit of math on this. And if I do a little bit of math on this, basically the change in price is going to be the function of three chunks. So the three chunks, we're going to have that future PE ratio. So this is going to be the PE ratio that I'm projecting for period one times the change in earnings. That's going to be our first chunk plus the change I'm anticipating in the PE ratio times those projected earnings. That's going to be a second chunk, plus the change in the PE ratio times the change in the earnings that we're expecting. Now, if you look at that and you think, all right, so basically, if I'm using this, then what's sort of governing this is what happens to that PE ratio. In other words, what people are willing to pay per dollar of earnings and what's happening to the earnings. So that's what's dictating the change in the price. Well, if we made a simplifying assumption, then if I assume that PE ratio is constant, then the change in the PE ratio would be zero, because if the PE ratio is the same, then there's no change. And if there's no change, the change is zero. Well, zero times anything is zero. So if I have zero times whatever that change in earnings is, this is going to be zero. Change the PE ratio, this is going to be zero as well. So basically what would happen is if the PE ratio stayed the same, then the second term and third term would basically just turn into zeros. They would drop out. And what would be left is that basically that change in the price is basically a function of the PE ratio times the change in earnings. Now, let's just kind of pause here for a moment, because this is by no means a perfect model, and this is by no means meant to suggest that I can just use this all the time for projecting things. And in fact, if you're using PE ratios a whole bunch and you're calling it valuation, there are some problems with that, okay? Because it makes all kinds of assumptions, and you're really not digging into the details and so forth. So we're probably really shouldn't be considered a sort of a normal full valuation or anything like that. But what it does kind of indicate is basically if people were willing to pay, investors were willing to pay the same amount per dollar of earnings. So in other words, if a company earned $2 per share in earnings per share, and if people were willing to pay $10 per dollar of earnings, then I could take $10 of price per dollar of earnings times the $2 of earnings that they made. And that would say, I think the value, or I should say the price, would be $20 per share if people continue to be willing to pay the same amount per dollar of earnings. So I would basically take that PE ratio of 10 and basically I'd multiply it times an earnings. I guess I should say up here, the PE ratio of 10 times the earnings, that would give me my price. But what that would mean is if that PE ratio stays the same, then really what's driving the long run change in price is the growth or change, could be declining, in earnings, right? So from that standpoint, one of the things that's kind of helpful to think about is if I make a whole bunch of assumptions. So if the risk of the firm's not changing, and if the market circumstances weren't changing, and if investor preferences weren't changing, if a lot of things were staying the same, which is a lot of ifs, then really what would drive the change in price for the company would be the change in earnings. Now, keep in mind, this is earnings per share that we have here, okay? But what that would mean is we just want to make more earnings per share as long as we're assuming a lot of these things are staying the same. Now, the obvious problem with that is a lot of that stuff is not staying the same. And so that's why this model is it's interesting, and it kind of gets you thinking along the right way of changes in earnings are probably going to be related to that change in price, but it's overly simplistic, okay? So since that's overly simplistic, you could look at various other multiple approaches. You could try to look at a price to sales approach and try to come up with what you estimate to be changes in sales. And if you think a price to sales multiple is going to be constant going forward, or you think you know what it is for whatever reason, you can do a price to sales or price to book or price to cash flow or whatever. So various other multiples that basically do the same kind of thing. And they tend to be subject to the same kind of criticisms or concerns ultimately. Now, there are all kinds of other valuation models. So we could look at dividend discount models. We look at all the future dividends, trying to value the value today, and that could be approached. We look at residual income, looking at essentially excess earnings and above and beyond what was sort of required levels of earnings. We look at various cash flow models and so forth. There are all kinds of things. And inherently, since I stated in a prior video, the value of any asset or investment is the present value of all expected future cash flows. The idea of these kind of models sort of inherently makes more sense to me because we are using future cash flows. We're trying to find present value of it. This is more the at the heart of what a full valuation would be, something pertaining to that. Now, it still involves all kinds of problems that I mentioned in that prior video. I got to figure out what on earth the future cash flows are. That's problematic. I got to figure out what a discount rate should be. Problems with that. So, there are challenges here. Now, there are other ways you could try to arrive at the value of a stock. You could try to perhaps look at the value of the assets on the balance sheet individually, for instance. So maybe they've got a bunch of real estate. So I try to figure out what all the real estate is worth individually and then sum it all together and figure out, well, they've got all these properties all over the place. Each one is worth this amount. I put it all together. Then this is what the company's worth as a whole in terms of its assets and the balance sheet relative to the money they're generating from these properties and real estate. Then I subtract off whatever's owed and whatever's left is the shareholders. So you can try to do things like that. Now, that means you have to have a very detailed knowledge of the assets on the balance sheet, and what specific properties and what they're worth and things like that. But that's another way that you can try to arrive at this. And the reason why we would care about this is if we're trying to maximize long-term shareholder wealth, in the long run, that tends to be related to the stock price, which in the long run, we think tends to be related to value, which basically is going to be derived from cash flows, things like that. So that's why we care about these kinds of things. All right. Hopefully this video has been helpful. Thank you so much for watching and have a great day.